what was the first risk you ever took in your professional career?
I started a business and it was a personal training studio. Back in the early 90s, personal training was not a thing at all. Had a successful number of clients, all quite wealthy individuals. I gave it up, closed it down, effectively sold some of it, and packed up my car and drove to Sydney. Had no job to go to or anything like that. Went in a totally different direction to what I'd been doing.
Risk-taking tolerance now, has it changed at all?
I mean, these days I take many more risks. You realize that actually there's more risk in not taking risks.
So let's touch on the first private equity experience you had.
So it happened at the end of my time at EMAP. Millions and millions of pounds worth of revenue coming through. In fact, the division that I was involved in, we were doing about 120 million top line revenue and making about 40 million profit. The business eventually sold. It was a 2.3 billion pound sale.
Talk to us about the private equity playbook.
There's definitely a playbook in private equity where when we're assessing a company for acquisition, we're assessing how well that founder, if you like, is going to fit into the governance structure that we're about to put around them. The answer to that is they don't fit, that we're not going to buy the company, but it means we're going to risk mitigate that by putting someone like me into the business or have me on the bench to be put into the business.
Hello, I'm Kieran O'Connor and welcome back to the Calculated Risks podcast. Today for episode 12, I'm very excited to be joined by Nick Bradley. Nick is an ex-private equity-backed CEO who's been involved in over 50 acquisitions, 27 successful exits, and 3 deals worth over $1 billion. Since leaving the world of private equity, he now helps founders scale their business and get exit ready. He's also the founder of the Scale Up podcast by Nick Bradley, and he's the author of Exit for Millions. Nick, thank you very much for coming on the podcast.
It's an absolute pleasure. I'm really glad that we managed to get this scheduled.
Yes, I've been looking forward to this one. There's some outside events out of our control, but I've been very, very excited for this one.
Yeah.
I have to start the same way as I always do, and I'm particularly interested in the early stages of your life around risk taken, risk tolerance. So what was the first risk you ever took in your professional career?
So I started a business. I'm going to show my age now. I started a business when I was in about 18, and it was a personal training studio in Adelaide, South Australia. Now, for context, obviously personal training is a big thing now. Lots of people have PTs, all that sort of stuff. But back in the early 90s, personal training was not a thing at all. So I ended up starting that business, had a successful number of clients, all quite wealthy individuals. And I gave it up, closed it down, effectively sold some of it. This is actually my first exit. I sold some of the client lists to one of my friends for like 3,000 Australian dollars and packed up my car and drove to Sydney because I thought, you know what, there's something else here that I need to get into a different environment, a different world. Had no job to go to or anything like that. Had a few connections through those personal training clients and just went in a totally different direction to what I'd been doing. Now I was young, and of course when you're young, you're taking risks like that don't feel quite as difficult as they may be when you've got family and things like that. But I decided to pivot massively into a different world. So
you completely left health and fitness and personal training behind?
Well, here's the thing. I didn't know this was going to happen, but I went to Sydney, so from Adelaide to Sydney. And Adelaide's, if you know of Adelaide, it's not the sort of place you want to kind of stay forever. It's beautiful and everything else like that, but not very many opportunities. One of my personal training clients knew Rupert Murdoch, and particularly his nephew, a guy called Matt Hambury, who ran a business called Murdoch Magazines in Sydney. And I got an introduction to the marketing director of Murdoch Magazines, and they happened to have Men's Health magazine as one of their kind of products. And so, long story short, I ended up getting a job as the fitness editor for Men's Health magazine Australia, and then eventually became the marketing director because I had a marketing degree that I studied when I was running my fitness business back in Adelaide. And then that took me into the whole world of corporate and the media landscape for a number of years after that.
And what about now? Today, Nick Bradley in front of me, risk-taking tolerance now, has it changed at all?
Yeah, these days I take many more risks, but I think, and I can get into the reasons why I do that, and I think you just become comfortable the more you take risks, right? Your tolerance level kind of becomes, you realize that actually there's more risk in not taking risks, right? So these days I've got multiple businesses. I work specifically with founders achieving a certain outcome, which I'm sure we'll get into. And, I've got lots of different opportunities that are coming up every day. And for me, it's like the fear of not taking those opportunities and not taking those risks is greater than doing them themselves. Hasn't always been like that, but after many decades of doing this, you kind of realize that's how it works.
Well, I've spoken to many people who have built and sold businesses. I've spoken to people involved in the venture capital world, but you're the first person I've had who's been this involved in private equity.
Oh, wow. Okay.
So I have many questions. I'm sure my audience have lots of questions themselves. We're going to cover all those, but I do want to understand about Nick Bradley personally. What was the moment that you decided to move from Australia to the UK, and why?
Yeah, I think what was interesting about why I left Adelaide, to start with that quickly, I had great parents, great upbringing. My father actually left our family when I was 2 years of age and didn't come back until many, many years later. So my grandfather kind of grew me up as his son, if you like. He was like my father figure. But no one was very entrepreneurial. And money was always a big issue in our household. So my mum got remarried multiple times. Every time she was married to someone else, there was people knocking at the door trying to get money back that was, stuck on credit. So I left partly because I didn't want to be in that environment. Even though I had this small, successful personal training business, I thought, you know what, I've got to get out of this environment to learn, to grow, and everything else like that. But that instilled in me this ambition to be self-reliant, self-sufficient, not to have money becoming a thing like it was for my family. So to your question, when I went to Sydney, I was super aggressive and super assertive in terms of my career, got promoted multiple times. I ended up going from Men's Health magazine to another magazine called FHM, which you might have heard of. And I was the marketing director of that in Australia. They were number 3 in the market at launch, and we took it to number 1 within 18 months. That got noticed by the mothership of the publishing company that owned FHM, which is called EMAP in the UK. And then they seconded me from Sydney to where I now live, Peterborough of all places, to run one of the big divisions of that company.
And was the plan always to permanently relocate to the UK, or was this a temporary thing, see how it goes, and you've found it for you?
It was a 9 month secondment, but because I was ambitious, I had this kind of philosophy. I just want to see how far I can take it. I always said, how far can I take this? Because it didn't come from much, really, or certainly the perception of that. What can I do? And when this opportunity came about to relocate, so to put it into context, no one in my family had left Australia before. So I'm the first person to even get on a plane outside of Australia. It's not uncommon in Australia because it's a big landmass and a long way away. But I've done this thing. And then the first 9 months in the UK was really successful. And they said, we want to keep you. Interestingly, my dad, who I mentioned previously, was Scottish. So I had the ability to get a UK passport through that. So no contact with him, but have my birth certificates and whatever. So I managed to get the passport. So therefore I could stay in the UK. Did lots of things in that world. It's how I then got exposed to private equity as well. But I met my wife. She's English, and that was it. So 23 years later, so I moved there in February 2003. Yeah, still in the UK.
And you've still kept the accent.
I'm never going to lose the accent. And I still support all the Australian teams when there's ever an Ashes series or anything like that.
Good. It was worth mentioning, I lived in Australia for 14 months.
Oh, cool.
Melbourne mostly.
Yeah, great.
Traveling age, 20 years old, I think. One of my favorite experiences.
It's amazing, isn't it?
Beautiful place.
It's just a long way. If you're in the corporate world and business world, it sort of exists in a bubble. And one of the reasons I was keen to go to the UK was I just thought the experiences, particularly at that point in time, so 2003, before the market crash of 2008, the British kind of view of business was a big thing, almost as big as New York and that sort of stuff. So I thought, I just want to play the game in that market and see what I can do.
So let's touch on the first private equity experience you had. Talk to us about that.
So it happened at the end of my time at EMAP. So as I mentioned, EMAP, second biggest consumer publishing group in the UK. The subsidiary that I was working at in Sydney was tiny compared to what was going on when I moved over. But it was a business of around 5,000 employees, millions and millions of pounds worth of revenue coming through. In fact, the division that I was involved in, we were doing about 120 million sort of top line revenue and making about 40 million profit. Car magazines, golf, fishing, motorcycles, all specialist interests, and I was in that sort of world. Over the span of 5 years, I progressed through that company and got promoted to marketing and strategy director of the whole group, this division. And they came to us and said, we're going to break the group up. And this was around 2006. So I was asked to make 600 redundancies. There was me and two other guys across this whole division to literally take the cost out before a sales process. Now, I didn't know what that meant at this point. I'd done a few kind of licensing deals and got involved in some acquisitions, but not the private equity side. And as we went through the process of breaking the company up into components, into two main divisions, there were a lot of private equity investors that started to turn up to assess and look at what we were doing. The business eventually sold just before the market crash. It was a £2.3 billion sale, so one of the biggest ones before 2008. And half of the business went to a private family business called Bauer Media, the consumer side. And then the other side, which was more B2B, went to Apex Partners, which is one of the big PE firms. And so I just got exposed to that world through the presentations and the analysis and the due diligence and things like that. And it was kind of just, wow, this is just really interesting. And at that point, I hadn't thought this is a career. I thought I'm curious enough to understand how this world works from going through this for a period of time.
And up until now, you've mentioned that you've had multiple promotions. You've had a secondment in the UK because of your success, strategy director for a 100 million plus turnover company.
Yep.
Now I can see that the motivation comes from the lack of money when you were younger, as you mentioned, but what else? Because that will get you so far. But you know, how else do you think that you progressed so quickly and took on these high positions in that time?
Yeah, I mean, I was pretty ruthless, if I'm honest. And I think the problem with ambition that's really just there with ego and everything else is you don't know when to stop. It becomes almost like an addiction, right? And I think I've got a pretty addictive personality for things as well. So as I became more successful, got paid more money, I just wanted more of it, right? Which is kind of why it takes me into the world of private equity, as we'll get into, right? And I kind of fit at that time, I fit that world beautifully. And so for me, it wasn't really about the money as much. It was about how far can I take this? Can I be the CEO of this company? Can I run it? You know, it was so out of my original vision of what I could be capable of. As I started to get more success, I just thrived on that success. But would step on people to get to where I wanted to. If I was competing with someone for a role, there's no way they were winning. It wasn't a very healthy psychology at that point in time, but you know, it served me well to that stage.
And you mentioned that you had some exposure to private equity. Do you think, looking back now, you scouted private equity as a career, or do you think private equity and the people involved scouted you?
Oh, that's a good question. I think subliminally I scouted them, because what I did after that is I went to a business called Getty Images based out of New York, fully private equity backed. And that 2 to 3 years that I spent in that environment was probably the foundational stuff around what I would do after that in PE. Incredible, just the way they ran that business. And they were owned by a group called Hellman & Friedman, it's a big PE firm based out of the US. I was involved in the transaction that sold the business again to another PE firm, and it was another plus $1 billion transaction. But what I learned in that environment was the discipline, the precision, the focus, the confidence, it just incredibly well run. I hadn't even seen that when I was at EMAP, but I got into that environment and that became even more intoxicating.
And you were a CEO involved in these private equity-backed companies, right?
Not at this stage.
Okay.
I was later. At this stage, I was still going through the marketing and strategy area. So I was involved in a lot of acquisitions actually at Getty, because the founder is a guy called Jonathan Klein, South African chap. And it took 10 interviews to get a job there. The first couple of interviews are, can you do the job? The last 8, which are from different people at different levels interviewing you, are cultural fit. And they had this, people talk about values in companies. They had this list called the 7 leadership principles. It's very similar to the 8 principles here where we are in the UAE. Really focused. This is how you need to operate if you're going to be successful in this business. So it was that part. And then I met with Jonathan Klein, and he said, everything you did at EMAP, great. You know, we know your track record. We're gonna teach you something totally different here. We grow by acquisitions. Organic growth is okay, but we buy other companies. We're going to teach you how to do that at scale. Okay, cool. So I was involved in at least, I think it was 30 odd transactions over the course of 18 months, 24 months, just buying businesses, integrating them, flying out and, you know, taking costs out, doing all sorts of crazy stuff. But the thing I learned was this. strategy is important, but execution is so much more important. And Jonathan said to me in the first few weeks there, he said, there's lots of people here who are smart, clever, but we create and control strategy at the board level, and then everyone else who's employed here is here to execute, and that's what you're here to do. I was like, wow, I haven't seen this before. But that was the first foray into it. And then after that, it was 10 years of my life. Not there, but in the PE world.
So I want to start from the beginning of private equity for people that maybe haven't had as much exposure as you, for certain, and potentially me. How would you describe the differences between venture capital, which is the word that I'm closer to, compared to private equity? Yeah,
and there's a really big distinction. And the main reason that people kind of get it confused is it's still investor money, right? So it's just different levels of it. So venture capital is more focused on spread betting. So the idea being is I'm going to put a small amount of money in, let's say 100 companies in some cases, and I'm expecting a few of those to be winners. And the rest don't really mind, right? So the way that kind of works is a few, are moonshots, like big returns. There's a few in the middle that might pay my money back, and there's a whole heap that I'm just not expecting to ever get a return from, okay? Private equity in one fund, let's say they've got a fund of say $500 million, they will make 10 or so investments. It's usually between 8 to 12, but on average around 10 investments. So each of those businesses is around about, let's say, $50 million, okay? They expect 6, 7, 8 of those businesses to really perform and have a couple of dogs. So it's a different balance. But in order to do that, because they're buying businesses at a later stage, they're more established, they're pretty much always profitable, and they have scalable, predictable, repeatable kind of potential into the future, growth potential. And they want to be able to go in there, and there's a really interesting thing for people to understand. If you understand this, you'll understand how private equity thinks. There's two main metrics that the PE firm is measured against. One is called IRR, so internal rate of return. Same as VC, so how quickly can the investors get paid back? But then there's a thing called multiple on invested capital. And so let's say I buy your business for $50 million, and then I say, okay, we're now going to put another $50 million into this platform to buy other businesses. I've put $100 million of capital in total. I'm assessed on whether I can turn that $100 million into $300 million, or more likely $500 million within a 3 to 5 year window. So we're not talking about small percentages here. We're talking about 100 percentage point movements, and that's what I'm assessed against. So different game and different outcomes. Hence the reason why there are so many of the billionaires in the world come from the M&A and private equity world than anything else.
And you're involved on the buy side as an operator. So for people that have had no exposure to private equity, talk to us about the private equity playbook, which is the common restructuring, and how do you play a part of that as an executive?
Yeah, so when I was a CEO, I wasn't like a founder who sold their company, right? So the difference is I was the one who was put in when the founder didn't perform. And there's definitely a playbook in private equity where when we're assessing a company for acquisition, we're assessing how well that founder, if you like, is going to fit into the governance structure that we're about to put around them. And doesn't mean that if the answer to that is they don't fit, that we're not going to buy the company, but it means we're going to risk mitigate that by putting someone like me into the business, or have me on the bench to be put into the business at some point where we think that there's a risk that the investment's going to go backwards. So the first thing to understand is that private equity, they reverse engineer from that ultimate outcome when they're assessing and going through the buying stage of the business. So they're already thinking about what the exit is 3 to 5 years down the line at the stage when they're doing due diligence. And if you just think about that as a concept, no founder thinks like that, right? It's a totally different way of thinking. If they did think more like that, they'd have better outcomes, right? Because you're getting this clear vision and view back. So that's the first thing. The second thing is that when we go and make an offer on a business, there's a thing called price and terms. So the price is what we say we're going to pay for the business, but then we're going to go through a process of what is called due diligence. It could be anywhere from 60 to 90 days. And that is an incredibly forensic look at your business. So anything that you've got hidden in a closet somewhere is going to come out. Mm-hmm. As we're doing that, of course, you're getting more attached to the outcome. You're thinking this is going to be a huge payday for me, 8-figure exit, all these sort of things, all these emotions that you get. But we're looking at how we can do what's called a retrade. We're looking at how we can buy the business as cheaply as we possibly can so that we get as much of the value for ourselves once we've bought the business off you. So sometimes that means lowering the offer. Sometimes it means not lowering the offer but giving you poor terms. So we'll give you 60% of the valuation on the day we close, which can still be a lot of money. But then the remaining 30, 40%, you're going to earn that over 3 years on the numbers that you told us you would hit. But we now own the business. Now, that all sounds horrific, right? You're thinking, why would you ever sell your business to private equity if that's the playbook? Well, as I said, if you understand two things, you understand it's unapologetically about money and those different measures, and that there are rules of any game, right? Rules of engagement. If you understand the rules and how it works, you can then align yourself to that if you want to as well. And you can create a lot of wealth and impact or whatever the goal is by utilizing the capital and the resources of private equity for your own advantage.
So the due diligence is very important, very, very important throughout the process. But it sounds like the founder is as well. So
Yeah.
I want to cover both sides.
Yep.
What type of person makes it very, very difficult for private equity to come in and do the playbook? And then describe the founder who is the private equity ideal person.
Okay, perfect. Well, let's start with that. And sometimes as I go through these kind of archetypes, you can see a founder can change as well. So it's not like, what's that famous saying, the leopard doesn't change their spots, right? The creative visionary founder, creative visionary entrepreneur, who has huge control tendencies and wants things to be perfect, which a lot of really creative founders are like. If you look like a Steve Jobs, for example, very passionate, very focused, don't work well usually in a PE environment. Now, they might sit on a board or be an advisor, but you don't want them running the business, right? Now, the reason for that is, remember, we're buying companies at a certain level. They've already got the foundations in place. They've already got a certain amount of profit. We want creative ideas or strategic ideas, but we don't want too much of that. We want execution. So the person who comes in, if they can't operate with a board around them, if they can't get used to the idea that it's not just one person creating the strategy of the business, there's a few people involved with different expertise, that everything is measured and process driven and structured and almost military in its execution. So automatically, if someone's a visionary entrepreneur, they're going, oh, this is hell on earth. I've got no creativity anymore. But in the world of PE, that's the way it operates. It's not interested in creativity. It's interested in what can create value.
And I want to talk about the macro level of the UK, because I was very fortunate to watch a documentary very recently, actually, because of this podcast. And I had a exposure to the last decade, I believe, of private equity coming into the UK and I guess eating up a lot of the businesses on the high street, potentially, and some others, which you will know better. What does that mean for the people who aren't involved in private equity? How does that affect the daily person, knowing that private equity is eating up some of the biggest names in the UK?
Yeah, I mean, it's a great question, because I think there's two ways of looking at this, because the general perception of it is, oh, that's bad, because all they're going to do in there is rip out costs and everything else like that. But you have to realize that the more important thing of PE isn't the buying of the company, it's what they do with the company afterwards, because they want it to operate in a certain way that drives growth, creates opportunities. And a business usually that hasn't got that level of precision to them, is risky, can go backwards very, very quickly, and people lose jobs. So the thing I think about this is PE plays a very important role in the whole world because of the way that it thinks about capital. Obviously, it works better in a capitalist kind of environment, not a socialist environment. But if PE comes and buys a failing business off the high street, well, that failing business was probably going to go into liquidation anyway. And private equity is not buying it to liquidate it. Private equity is buying it to make it more valuable again. So in that situation, share prices, whatever investment you've got, obviously jobs, as I mentioned beforehand, it's a better thing. So it depends.
Let's bring it back to Nick Bradley then. The first time you stepped into a CEO position, away from marketing, away from strategy.
Yep.
Tell us about that.
Yeah, so as I mentioned beforehand, I was not the founder who started and sold the business. I was injected in, and usually as a turnaround guy. So the first time that happened to me, it was actually for a group called Reed Recruitment. So James Reed, you might know who he is. Sir Alec Reed as well. So I reported to James Reed. Now you might think, well, hold on, that's a privately owned company, but even the privately owned companies have investors and all sorts of things floating around the place. So you've got to think the environment and the expectation in those environments is the same thing. So I was brought in to turn around the learning division. It was called Relearning, part of that group, because they had, it was failing very, very rapidly. And I had to effectively go in there and restructure the teams. So get rid of people that weren't performing. Sometimes the people in those businesses have been there for a long time and there's lots of personal relationships. It's often said, and I believe it to be true, that being the CEO is the loneliest role, particularly when you're going into an environment that you haven't created. So if you've built the business from scratch, it's your team, it's your friends, you've built that. If you're going in there to turn something around that's already got those foundations, but poor foundations in place, you're kind of the enemy sometimes coming in. So I remember not realizing, because I'd sat on the other side kind of more assessing businesses, not actually being as involved in running them. And I'd been either in the leadership team, but not at the top table. I found that quite difficult in the beginning. You had to be really, back to managing emotions and detachment, you had to be really detached and focused on the outcome to be successful. And then once I did that, I did it a few times over and became known as a person who was brought in at that stage to fix things that weren't optimized.
I want to come on to the detachment part very shortly, but I have more of a psychology or behavior question to you, because you seem like someone who is very self-aware of your strengths and you play to those. Stepping into a CEO position, how quickly did you notice or realize some gaps in your skill set, and how did you work on those?
Yeah, one of the first things was, in terms of self-awareness, was probably more on the emotional intelligence side. And this was something that I struggled with even through some of the senior roles before I was a CEO. Because as I mentioned, I was quite relentless and quite ruthless to get promoted. And so I would be I wouldn't be very supportive, is probably the best way to say it. So if someone came to me with a problem, I'd be very dismissive of that. Of course, that doesn't engage people. It doesn't, warm you to people. So that was one of my Achilles heels in the very beginning. Because people would be like, what was I called? A bit like a grey man, I think was the terminology, if that makes sense. Yeah. This idea that there's a person behind the eyes, but I don't know who the real person is, because I was almost machine-like in my focus and operations. And so that was challenging. You can't be an effective CEO unless you realize that people are motivated by lots of different things. And the emotional side of that is as important often as anything else. It's not just about how much money someone gets made. People are, interested in the impact that you're trying to make. They're interested in kind of what's in it for them. And I wasn't as aware of that, certainly in my early part of my career. Had to get very good at that quickly. And there was some very painful experiences of where that became acute as well.
I think that's a stereotypical private equity CEO or a ambitious founder who has that trait of consistently moving forward, maybe doesn't lack it, but it isn't as focused on empathy or understanding. I certainly have that.
Have you had that?
At points, yeah. And I will be honest, and I've had to really work on that from a personal perspective outside of my profession with my relationships. And I wonder how's that affected you over the years, because a private equity-backed CEO on the daily, that is a high-stress environment. There is execution needed. But then, with a wife and children as well, where's that switch?
So let me share this story, because I think it's an interesting thing. This changed a lot for me. And there's a reason why I don't work specifically in private equity anymore. When I met my wife was around the Getty time. And then I became a dad sort of through that world. So I was kind of in the beginnings of the private equity thing. But it was also the same time that my dad came back into my life. So remember I mentioned he left when I was 2. He came back when I was in my sort of mid-30s, just before my first daughter was born. And he was a super successful entrepreneur, but he went bankrupt twice. In fact, the first time he had a jewelry business in Melbourne, and it got blown up by the Turkish consulate bombing back in the 80s in Collins Street. And of course, there's no insurance for things like that. So he lost all of that. Then he built another business again and ended up retiring in his 50s. But I didn't know any of this stuff. So some of the entrepreneurial tendencies that I have now, I was repressing. I'm quite entrepreneurial, but I didn't think I was because of various things. When I spent some time with him, I realized that there were a lot of these innate sort of values and behaviors of mine. The sad part of the story is, in the very short space of time of us reconnecting, he ended up getting cancer and died within 12 months of that diagnosis. And it was at that point that I decided, you know what, I'm going to get out of this private equity exploitive part of the ecosystem, and I'm going to work more exclusively with the founders who create the value. So in answer to your question, it was an awakening, if you want to call it that, of becoming a parent and realizing there's more to life than just success, ambition, career. My dad coming back in and seeing what he went through and realizing that there were more of me in him and him in me from what I expected previously. And then looking at the world that I was in from a different perspective from that and going, oh, maybe there's a different way. And then I had to go on my own personal development journey, which I did through that, which then sort of resulted in the podcast that I've got now launching. And now obviously what I do, advisory and consultancy in different ways.
Well, thanks for sharing that story. I appreciate that.
Yeah, it's the, you know, you look back on things in hindsight and you realize that at the time they're really difficult, but they're the thing that made the biggest difference. That my wife was the one who meddled. This is the funny bit because I didn't want to see my dad, but she reached out to him and that all happened, and it was the best thing she could have ever done. But if I hadn't have met him, I always think this, if I hadn't have met him and had that experience, would I have stayed doing what I was doing? And to be frank with you, I was not a very good husband and father, even though I was kind of always quite aggressive and focused on work. I wasn't showing up how I show up now. And I had to go through, I think, that kind of sort of dark point to be able to appreciate what I needed to do next.
Well, that's very powerful. And I haven't shared this publicly, but we're expecting our first child.
Oh, wow.
So
congratulations.
That's an exclusive. For you to say that's actually helped me quite a bit. Yeah, to realize that.
It's the most amazing experience. Honestly, I'm like, what did my wife call me? She calls me the soft touch now. But here's the funny thing. From the perception of what we talked about earlier, this kind of machine going in and doing all this sort of stuff, I kind of realized I couldn't do it anymore. Like I can't turn up there, even in private equity. I couldn't go back and do. I still have tendencies of those skills and capabilities, but I just don't buy into it in the same way. So I hope that you know, when you become a father, you'll see that as well, because it just changed things, and it's a much more healthier relationship to have with yourself. It certainly was for me.
Well, let's stick on the personal topics for a moment. There's two different questions I have, and you and the team were very kind to share some information to me before about topics, and there was one that stood out. There was a time where you lost 2 teeth, I think, during your sleep, during your private equity time. I can only assume because of stress.
So I didn't lose the teeth. I broke my teeth, right side of the jaw. And it kind of comes together with everything I just shared with you. And I'll give you a little bit more of the perspective of that. So we were closing a really big deal. I've been involved in 3 transactions over $1 billion. So I mentioned the EMAP transaction, then I was involved in the Getty. The last one was a business called Ascend Learning. And I was the CEO of the international division of that business. So there was a group CEO and I was running sort of the overseas part of that. And it was really challenging because I was put in to do what I normally do, but I was removed from where all the leadership was. So I was based in the UK, everything was based out of Boston. There was lots of internal politics. When you're involved in transactions like that, the money is obviously significant. So I was kind of sidelined. So that was going on. Same time my dad was dying, so that was going on, and I remember lots of stress. And I was also running ultramarathons, so this is another weird part of my personality.
That was my next question.
I thought you might get into that. We'll get into that, and I can tell you why I was doing that. I was doing lots of stress. So just imagine you've got all this pressure, all this stress, and then you're suddenly questioning everything around you. Right? It's really disconcerting. So one night I went to bed, and I wasn't very healthy at this stage, and I don't remember actually doing it. I remember what happened. I remember waking up and I had this pain here, and I went to the bathroom and looked in the mirror, and this side of my face was swollen, and I could sort of taste, like, you know, when you know something's not right. And I called the doctor and the dentist. I ended up going to the dentist the next morning, and she said, "Yeah, you've cracked 2 of the molars here." And I was like, "You're kidding?" She goes, "How does that happen?" She goes, "Oh, it happens when you're in high stress environments." And she said lots of people in the financial areas and traders and things like that, it happens, but it's unusual. And she just said, you know, you've got to stop what you're doing, right? You've got to stop this. So that happened, and that happened through this. So that was the kind of visceral experience, but everything else that I shared with you previously was going on. Anyway, what I ended up doing, and at this stage, the transaction for Ascend Learning was going through, and I just was feeling really bitter about that whole world. I called up a friend of mine and explained the situation of what was happening. He'd actually retired in his 30s, built this amazing business and sold it. And he said to me, you've got to get yourself to a different room, different environment, which kind of connected with when I left Adelaide to go to Sydney. I thought, oh yeah, that worked last time. He said, get yourself to a Tony Robbins event. So 2018, I go online. I find that there's this Unleash the Power Within event in Chicago in about a month's time. I say to my wife, I need to go and do this. And I didn't really like Tony Robbins much. I was like, weird dude, big head, all that sort of stuff. But I went to this thing and it was the best experience in the world. So there was a quote that was put up, which was from Zig Ziglar, which said that if you help enough people get what they want in life, you'll have everything that you want and need in life, right? Mm-hmm. Never heard that before. And as soon as I saw that, plus other experiences over those 4 days, my whole belief system around that changed. I thought, oh, wow. So instead of being exploitive, right, I can actually go out there and help people get what they need and want, and then I'm going to be looked after, which I think my fear was, I've got to get things, otherwise I'm going to be like my parents were. So anyway, they do meditations and all sorts of crazy stuff. I don't know if you've ever been to a Tony Robbins event.
Not yet.
Okay. They're worth going to. I mean, I've done all of them since. It was amazing. He does this meditation, which is called the Dickens exercise, where he makes you look at your life sort of past, present, future. And it's pretty powerful. And I remember two things happened when he was going through it. One was this voice in my head saying, trust yourself. I thought, what does that mean? And the idea was trust yourself that you'll be fine if you get out of this world that you've been in. And the second thing was the podcast. Like, maybe I should share my story. You know, it wasn't really, there was a back end thought that, you know, that could help me then create a business and help me make the transition. But I thought maybe I can do that to help people as part of my new belief and then do something for myself as well as part of it. So I came back from that. So this is 2018 and then didn't do it straight away. Procrastinated on it for a while. But February 2019 is when I launched Scale Up Your Business. And then that was hugely successful very early on. And one of the first podcasts I think that was ever about business growth and scale from a practical standpoint. And yeah, it was very popular. And that was the change.
Let's talk about the podcast. Let's talk about the book. Before that,
sure.
I think we have to mention the scale of marathons and ultra marathons you've done from one man to another. Let's put it on the table. How many marathons, how many ultras?
So in total, it's 67 marathons. But within that, there are 24 ultra marathons.
That's incredible.
Yeah. And the longest is 100 miles. Best result was a 100-kilometer race in Vermont, which is really powerful too, because my dad, before he passed away, he came and crewed me. So remember he left when I was 2, so he wasn't around. So he had this it took me 12 hours to do it. He had this one day of being my dad properly, which was amazing. So I came 19th in that race. And then, I remember doing the Brighton Marathon and the London Marathon in consecutive weeks and did exactly the same time, which is crazy. Like, it was within 20 seconds. So, yeah. But I think the thing about the marathons, and I know this now because I don't run as much anymore. You know, I still go to the gym and stuff like that, but I don't put myself through the rigors of that. I was absolutely not liking myself through that part of the world, like how I was showing up and the exploitation and all that. And I was running to run away from that. Yeah. And it made me feel bulletproof and all these sort of things, but it wasn't the right psychology at that time for me.
Well, I've just started on that journey. Okay. I played semi-professional football. I never really did any running, but surprisingly, I've always been relatively fit. Yeah. Stopped playing football and realized I need to, keep this up and start running. So I've done 4 or 5 halves. Great. 1 marathon, but I found a love for ultras. Yeah, so I've done 4 in the last maybe 15 months.
I didn't realize that. That's fantastic.
Yeah. Heard of Tough Mudder? Yeah. So I've done the world's toughest mudder, which was 24 hours. And I want to ask you, because you've done more than me, and you've obviously had a lot of exposure to this world. Like, what do you think that taught you? These long distance runs. What do you learn about yourself?
I got really into it. I even founded a race that still goes to this day as well, an ultramarathon in St Albans back in the UK. I was really in the scene, like knew everybody, all of that. It's a couple of different things. I did it for different reasons, but I think anything that you do that's hard, makes you stronger, right? Pretty obvious thing to say, but particularly if you don't expect that you can do it. So the idea of something, well, there's a challenge, but I know I can achieve it. Well, is it really a challenge? Maybe it's a bit of a challenge, but it's not the same as, lining up to a 100K or 100-mile race. And there's no guarantee you're going to finish that race, right? A marathon's difficult. I actually think ultramarathons are easier in some ways because it's not about just running at full tilt. It's about strategy and negotiating how you transition yourself physically and mentally through that amount of time. And I remember, to share the story with the Vermont race, up to the first sort of 50Ks, I remember coming into one of the checkpoints and I was dead. I mean, I could hardly walk. Like, I looked like everyone thought I was going to crash. And my dad was like, do you need to drop out? And I'm like, no, I'm going to keep going. I saw him at the next checkpoint, which was about 10 miles on, and I'd run past all these people and I just looked like a different person. And that happened in the same race. So it's kind of, you learn a lot about resilience and tenacity and self-belief in those areas, because again, it's a visceral experience, as you know.
Mm. That's an interesting point about the ultramarathons being sometimes easier than marathons, and I partially agree, actually. Yeah. It's not full pelt, and you have to strategically run the race.
I hate the pressure of having to run to, if you're running for time, it depends if you're doing. I like to compete in these things, and I used to have certain goals of what I wanted to hit, and I'd be looking at the watch, and then do I need to go to the bathroom? What's that going to do? And that was hard. So when you go and do an ultra, as much as you want to compete, it's a different environment too. Sometimes you're walking, if you're going up hills, you're talking to other people. It just feels like more of an experience for me, different experience, but I enjoy it.
And to finalize on that point, I think for me, resilience.
Yeah.
50K in, 60K in, the body's saying stop. 10K go past, stop. 80K, and you can just keep going. And I think that transfers into, especially business life, but just life in general. You just can keep going.
I think the more resilient you are in life, because everything's, it's like, as we record this, there's lots of things going on. You can look at that in so many different ways, right? I think the more resilient you are, just generally, you put things in perspective better than people who kind of just panic at the first time something goes wrong. And I think the thing that I learned from ultras as well is that, as I mentioned, in any one race, you are going to have multiple things go wrong. And it's whether you decide to continue. You've got to say, well, am I going to continue? Am I going to stop? What does it mean? You answer so many questions of yourself, which then, as you said, translate into other things in life.
I'm so curious about the private equity stuff, but we can't go back just yet. The scale up, Nick Bradley, 400 plus.
Yeah, 400 episodes. Yeah, 1 million downloads across about 130 countries. Yeah, it's been great. It was number one in the UK for a long time before Stephen Bartlett decided to come in there and destroy that opportunity for anybody. And that was huge. I don't know what happened there, but we were about 9 weeks, we were number one business podcast. And off the back of that, people reached out saying, I love what you said. And a lot of it was just me. I didn't do interviews. First 25, 30 episodes was just me and a microphone weekly talking about different things, different practical things that you need to learn in business, as well as some of my experiences. And then all these people just reached out. And I started doing coaching, actually, business coaching to start with, while I was finishing off one last private equity role. And then after that, I managed to build something that allowed me to transition and do what I'm doing now on my own terms. So it was great.
The podcast, to summarize all of those episodes, what's one thing that has improved for you personally? And then I can't choose an episode, but what's the one theme that has stuck with you and changed your perspective?
Yeah, I mean, the first thing, I do a lot of speaking now. And I remember back in school years ago, and I learned this a bit through my corporate career, but I was terrible at it. And now when you're talking all the time and doing this sort of thing, you just get better at it and just better articulation. So for me, it's the muscle memory around that, which has been great. And that communication has allowed me to meet lots of people in lots of countries, to get invited to go and speak on shows like this and speak on stages in America, which has then turned into business partnerships. And I've got 7 separate companies now, different equity positions, and a lot of those have come initially from this. I met them through this medium. So that's absolutely huge.
And the book, Exit for Millions.
Yes.
I know how much psychological warfare goes into writing a book.
Don't know if I'll do it again. I've got to say, Kieran, it took about 2 years to write, and it was actually a lot bigger. It was 360 pages. And then I thought I wanted this to be something someone can read easily over the space of a weekend. So yeah, it's a bit more concise now.
We should feel proud because writing a book is very hard.
Yes.
I'm sure we can both agree. And my question for the book is, how much have you shared in that? For people that haven't read it, how in detail have you gone on the private equity secrets, if you like?
There's a lot in there. So one of the chapters is called the 15 reasons why your business won't sell to private equity, which, you know, you asked me before about podcast episodes. That's my most downloaded episode. And but basically because it just rips apart all the things that you can do in your business or need to do in your business if you want to achieve that 8 to 9 figure exit. So some of them are pretty straightforward. Founder dependency, recurring revenue, all that sort of stuff. There's very technical. So I go into that. But my favorite chapter is demystifying what the world of private equity is like. And we do it through this, like turning up, there's a club in London, a wine club in Pall Mall, which hasn't got a sign on the door. And it's kind of considered the private equity club. So you have to know it's there, secret handshakes, all that. And we explain the world of private equity as if you're in that club for a night. And you've been invited in just to listen to the conversations. And so it's quite fun because I could have just made it very technical, and there is a lot of technical stuff in the book, but I thought, let's have some fun with this. You know, if you're in that world for one night, what are you going to learn? So do that.
Well, let's imagine I'm a founder of a company that is looking to sell to private equity. I've got interest.
Yep.
What are the principles that me as a founder have to understand about private equity on the other side of the table?
So as I mentioned before, the metrics, the IRR and the multiple invested capital, understanding that they're measured on, you know, trying to extract your business from you as cheaply as possible to make as much return for their investors. If you understand that that's what's there the whole time, you can use some of that psychology against them. So before we started recording, we talked about the emotional detachment and side of things. Private equity are also trained to draw you in emotionally, so that at the end, and I've had a couple of examples of this where, you know, just at the day of signing the deal, we changed the rules. And it's like, well, do you want to be a millionaire now or not? All right. And if you don't sign it, we're just going to tell every other private equity firm that your business is damaged goods. Right. So there's those sort of things that go on. Again, don't say that to scare any of the founders listening, but understand that that's how they're measured. The second thing is there's two sorts of value. There's the financial value, which is the profitability. So the ability of your business to convert profit to cash. That's one of the most important things. So if you've got this business that's, you know, growing, lots of revenue, losing money, it's a tech thing, whatever else, private equity in particular don't get too excited about that. They get excited about when that converts to cash. That's about 40% of the valuation. The other 60% is the transferability. So that's the leadership team that you build around you. It's all the processes and the systems. It's the ability for your business to be able to grow through other acquisitions being bolted onto it. So if you understand that that's what they want to do, they want to take the thing you've built as an asset and they want to grow and scale that asset to create more value. Everything that you can do, and there's a lot of technical parts of this in the book, to do that in advance, then you're going to get the highest valuation you possibly can for your business. If you don't do that, and it can literally be, depending on the size of your business, tens of millions of dollars that you're not going to get, but they're going to get, you know, once the deal is done.
So earlier you mentioned that due diligence can take between 30 and 90 days
Yep.
on average. Let's imagine this founder has decided to sell their business. Perhaps they haven't instructed someone like you to come in and help with the due diligence on their side. What would be an average figure that a private equity would look at in terms of revenue to buy a business?
So there's two things I'll say here, which I think is interesting. One is if you are, and I'll give some arbitrary numbers. It's not always like this, but just to kind of talk through this. If you're over $5 million of net profit, or what's called EBITDA, technical name for net profit, it opens up the buyer marketplace. And it's called the mid-market in private equity. So over 5 million is where you've just got lots of firms and lots of capital. And your chances of selling your business for 8 to 9 figures once you get over that 5 million are around 8 out of 10. Right? Of course, you have to have, you know, a market that's, you know, not getting disrupted and other bits and pieces. But generally speaking, you've got the financial foundations in place. If you've got a business that's doing a few hundred K of profit, or $1 million or just over $1 million, you might get acquired, but you're going to be bolted onto something else. But generally speaking, the valuations are a lot lower at that level because there's not enough there. There's not enough substance to be able to kind of grow from, right? So in other words, the PE firm has to do more of the work. So when you're at that level, and certainly below $1 million of profit, your chances of selling a business are about 2 in 10.
Wow.
So I say, and this is how we help a lot of the founders, is we'll bring businesses in that are quite early stage, and we want to get them to $1 million of profit. Once they get to $1 million of profit, we want to help them get to that 5 million, usually by buying other businesses and creating more of a group, doing exactly what the PE firm would do if they bought you. And then once they get over that level, then we can run a process for them. But the difference is, and I'll say this because a lot of founders get it wrong, they build a business, they don't know what it's worth, they hire an investment banker or a broker. Crazy this, I still get astounded by this. It's kind of what everyone's done. The broker's not there to improve or advise on that part of the business. The broker is there to sell the business, like a real estate agent selling a house. And so if you leave it too late, some of the things that we've talked about today, they take 12 months, 24 months to kind of go and fix, right? You can't just, put the business out there and expect, those things are going to get miraculously changed. So in that situation, most people kind of get disappointed and they say, oh, it was a bad experience and I got exploited by private equity. And I go, well, you didn't prepare. You spent all this years building your business, but you didn't spend the last, say, 24 months making sure that you are going to sell for the number that you want, right? And that's why what we specifically do is that. The preparation phase, which can be that 12 to 24 months. And then I've also got an investment bank called Arcane Swiss. We run the transaction as well. But we think that the uniqueness is the fact that you do both of those things, whereas most people just think about the end.
That's very helpful for founders because that's the angle I was going down. I imagine, you might tell me I'm wrong, most people probably leave it too late, identify they want to sell a business in 6 months. But you reckon 12 to 24 months minimum is the time needed to restructure? Yeah, it
depends on what your goal is. So sometimes people, one of the things we do, we call it clear end game. It's one of the principles in the book, which is that reverse engineering from an outcome. So I often say, okay, well, what's the number you want? And people go, oh, I don't know, I haven't thought about that. Crazy how many people do. Well, that's kind of the starting question. So what's the number? Why does it matter? And is what you're doing now going to get you there, right? Oh, I don't know, right? But as soon as we have clarity on the number, and whatever, I don't mind, you might say, I want to sell my business for 100 million. I've got one client at the moment that's just fixated on that number, just to prove that they can. I'm going, okay, well, we need to get you to at least 10 million of EBITDA, right? And then at 10 million of EBITDA, you might sell that for 10 times. That's the average on that. So there's your 100 million exit. Great, okay. So I'm now at 3 million of EBITDA. I need to find 7 million. Yes, that's exactly what you need to do. So in those sort of situations, and to answer your question specifically, the founder doesn't know what their business is worth. They don't know what they want to get. That is usually a rushed process. The first thing you should do is get your business value so you know what you've got today and know that number for tomorrow, and then you've got choices. Sometimes when we get involved, the founder has a number, we do a valuation on the business, and that number aligns with what it's worth, and we can go straight to market. We're really comfortable that it's going to get that outcome. But more often than not, it's that 12 to 24 months or even longer, depending on your number, right? So if you want to get 100 million exit and you're at $1 million of EBITDA and you're going to find another 9 million, that's not going to take a year. That might take a few years to build up that level of value.
And there's lifestyle businesses as well, which many people choose. I'm sure you have your preference from the industry that you are in.
Yep.
And I imagine just through meeting so many people like you and my network as well, there's no man's land, we might call it, where people aren't sure of its lifestyle. They're scaling, but they haven't really identified an exit. But what about lifestyle businesses? How do you personally feel about those? Of all of your experience in private equity, what do you feel about those?
Yeah, it's a choice. So, and sometimes people come to us and they haven't made the decision to sell. Like the people that we work best with have made that decision and they know what they're trying to go for because we can work on that. And the private equity playbook works well for that. I believe there are 3 exits that a founder has to go through. You don't have to do all of them, but if you want to sell your business for a lot of money in the future, there are 3. The first one is exit the chaos, which most sort of early stage founders are in. And that's really where they're putting out fires. They don't feel, I started this business to get freedom and I'm trapped in it, all that sort of stuff that you hear. And they stay in this kind of almost like the hamster wheel cycle because they don't realize that they're the cog in the whole thing anyway and they're the bottleneck. And so they live in that chaos for a long time. And I think that's the main reason a lot of businesses close down. Not because they couldn't have been great, because the founder is just tired and gives up. So exiting the chaos is really about making sure that you create predictability around your revenue. You've got some basic systems and processes in place, and you've got this ability to convert that revenue to cash. Okay, so you look at the business through those kind of three lenses. Once you've exited that, and you've kind of got to think it's kind of working, but I'm still involved day to day, whatever else. The next exit is called exit the operation. And that's where you have to build a leadership and management team. And quite often through that process, you might find a new CEO to come in and run the business for you, give them some equity. And in that case, you can hold that business if you want to, for as long as you want to, because you're just the investor. You might sit on the board as the chairperson, but the business is growing, it's run by others. In that situation, both of those first two examples can be lifestyle businesses, depending on your definition. But that second one, where the business runs fully independent of you, it's high cash flow. I've got a couple of clients who have come to me and their businesses are doing 2 to 3 million of net profit, and they've been taking that as income, if you like, for the last decade. But then they're in their 60s, they've got no succession plan, and they're like, what do I do, Nick? And I go, well, the third exit is exit the business. Do you want to create enough value here so the business is an asset, and then you can sell your shares to someone else and have this liquidity event which could create generational wealth for you or whatever, even though you've made lots of money through the process. So my view is the three exits. If you choose to not go all the way through, that's great, but you are going to exit your business at some point. Like, your business is not going to live forever. It's going to, we all die, unfortunately, that'd be morbid. So I personally think, my personal view is that the secret is optionality. So if you build a business that has the ability to sell, even if you never choose to sell it, you're giving yourself the maximum optionality. And that's what I try and instill with everyone we work with. So I don't care if you sell your business or not. I care that you have a business that is investor grade and can be sold, and then you make that choice. What happens, I'll finish with this bit, is that once people build to that and they see it and they realize that it's valuable and people are knocking on the door wanting to buy it, they normally go, oh, let's do that. On their terms, on their timeline.
I think it goes without saying that in any business, management of emotions is very, very important. But it sounds like private equity, emotional attachment is just necessary. And you mentioned off camera that you've actually had training on how to...
Yeah, we had military. We had, I forget which part of the military, like special operations type part, like secret service type stuff. So we used to have different trainings in my PE world. And one of them in particular, I remember for a few months, we had these sessions which were all about, it's kind of like they were modeled on military sort of heat in battle type of stuff. And the whole idea, it makes a lot of sense, is when you're dealing with big numbers, so transactions in the 8, 9, 10 figure range, if you look at it like that, you're going to freak out, right? You're making a big decision. If you get it wrong, it's going to be, detrimental. So we were taught to be able to make those decisions. And a lot of it was through role play and just trying to, how you deal with a founder that you're buying the company from, all that. How we would just not look at that as being the big thing. The best way I can describe it is if I put, let's say, a piece of wood between two buildings and said, like a tightrope, and said, okay, you walk across that, and then you're looking down and it's like 30 floors. But I did the same piece of wood across something that was on some bricks at, a few inches above. It's the same thing. But the difference when you're looking down 30 floors versus that few inches changes the whole psychology. So we were taught to be able to operate as if we were walking across the 10 inches, even though the stakes are much higher than that.
That's a good way of putting it. That brought me back to my bungee jump. When I was looking out above, do not look down, do not look down. And I looked down, I was like,
it's crazy though,
oh
isn't
my
it?
God.
Because you think it's what you're actually doing physically is the same thing, exactly the same thing. But the stakes, it really is the stakes and the risk and what that could happen. That's all psychological to you. And then you panic. And so you want to get to a position where you don't panic under fire, which is exactly the reason it was military. Is obvious that if you're, I don't know, in a war zone and, bullets are flying around and friends are getting killed and all that sort of stuff, you don't want to go into a panic mode and then be compromised. So it's a very similar type of training, I believe, to that.
I've spoken to many people on this podcast who have sold businesses, and I would say 80 to 90% of them had some sort of identity crisis, maybe shift crisis for some of them actually. There was only one, a great person called Dodge, who said he had no identity
Dodge
shift.
Woodall.
Yeah.
Okay. Yeah.
No identity shift. He sold 3 businesses out of the 5 he's had. And to him, just a business, move on. Yep. But the other ones, and I think the difference is that was their sole business.
Yes.
But how, firstly for you personally, identity shifts over the years, you are brought into, you were brought into the business to actually sell it. You're not there for a long time.
No.
Talk to me about your perception of identity and how do you handle it?
Yeah, I mean, mine, in terms of me personally, as I said, I would define myself more as an entrepreneur these days than I was beforehand, like as a PE operator. I have a certain skill set around operating a company and making it more valuable, but I now think of, like, I've got multiple businesses, I'm growing those businesses. I'm not really attached to any of those businesses, partly because I believe in building it as an asset anyway. So the business is there as an asset to serve my life. It's not there to define my personality or my, your word, identity. The problem, though, is that if you've had a business for 30 years, 40 years, all of your relationships are tied in that business. You're friends with your clients. Dora's been running the front office for 20 years. I've had businesses we've bought where the founder has come and said, don't fire that person because, they've supported me all the way through. It's like, mate, as soon as you buy your business, that's not your decision anymore. But that's all the emotional piece. And I think what really happens is people then, when they sell that business, even if they sell it for large sums of money, they lose those relationships. Everything changes. Quite often, they don't have the same friend circles, right? Like the guys you had beer with look at you a bit differently when you've got $100 million in the bank. And so there's depression that happens. It's crazy when you think about it. Someone's made this amazing thing, but they haven't prepared in advance again of what their next act is. I talk about this a little bit in the book, that if you don't have this thing that pulls you towards, what you're going to do next, that excites you just as much as what you did growing, scaling, exiting your business, the risk is that you'll kind of either sabotage the sale through the process. That happens. So right at the end, you just bottle it, or you're going to go into some form of uncertainty, anxiety, depression, maybe, once the business is sold.
Do you think that's because the sale process is so all-encompassing that it's very hard to plan after? When you're doing that due diligence for 12 to 24 months with someone like you, how do they think after that? How do they put the time and energy into to after? Well,
when we get involved, obviously we're going in there as friendly fire. So we come in as what is called operating partners, like I mentioned. So we're partnering with you for the outcome. So part of that role, mentoring and guiding that founder, is to help them realize what they're going to do next. So they've made the decision that they are going to have some form of succession, but they may not know what that means. And so I'll often say, hey, listen, do you want to go and buy other businesses? You're going to have a huge liquidity event. You can co-invest with us if you want to and go and buy some companies. Do you want to start a foundation? And a lot of the times it's trying to find out what their personal motivations are. And a lot of them are things like being a role model for their family, helping others. There's a big thing around, once you create financial stability and independence, about going to make bigger impact. Mm-hmm. And I often help people lean into that piece, because I think if they do that, then they're going to be more successful through that process. But to your question, all of this is about preparation, psychologically, mentally, emotionally. And you are going to go into battle, right? Even if it's someone that you're going to potentially partner with in the future, the new owner of your company. At that stage, when you're going through due diligence, it's a thorough risk analysis. But you can do things as the founder to protect yourself before that. You can have someone running the business for you, like I mentioned beforehand. You can focus just on the deal itself. You can have a team of different advisors. We call it a deal team. You create a deal team. So I get involved in that, lawyers, financial experts. So when you're going into this kind of battle, you're not going in there by yourself. You've got the A team, so to speak, around you. All of those little things make the whole experience so much better. And one thing I used to say in PE, which we used to we had this thing called prize versus prey. And prize business is a very successful business, scalable business. It's been built properly. The owner knows how the game is played. Prey business is the opposite of that, right? We like both of those. We just know we're going to pay a lot more for one of them and less for the other. But we used to have this term which was called the formidable opponent. So when we saw the founder that had learnt the playbook, built the team, understood how the game was played, when they showed up, there was a different level of confidence to them. And we'd go, we've got one of those. And you want to be, if anyone's listening to this and a founder who wants to sell their company, you want to be one of those.
I say this lightly, but the term whistleblower, you're exposing to a certain extent some of the secrets, some of the maybe unknown traits of private equity. When you are working with these founders to, get them exit ready, how do private equity feel when they see that you're involved?
They don't overly like it. Well, it depends. I have a lot of people, because I post every day on LinkedIn around this sort of stuff, and I talk a lot about PE. So one of the decision I made at the Tony Robbins event was to share as much as I possibly could. Partly because in PE you're not allowed to. In private equity, like, they control your LinkedIn. Like, you can't do anything. So I've got PE people direct messaging me on LinkedIn saying, "I'm so glad you're saying it." It feels a little bit like Jerry Maguire, the manifesto. So the key thing to think about is a private equity firm still wants to buy probably more prize businesses than praise. So even though I said the game is about buying as cheaply as possible, if I help a founder prepare their business and it's beautiful, like it's ready to go, they don't have to spend all this time de-risking that business. They're going to pay more for it, but the chances of them getting a really big return in the future by buying other companies and bolting them together is going to be better for them anyway. So the fact that they know I'm involved, they know that I've done the rigorous stuff that they would have to do. They know that they may have to pay a bit more for it, but that's okay. So it's not like they think, "Oh, this guy's terrible." I'm pretty honest about it. But the other thing is, I actually really like private equity, and I think the world has changed in PE. And there are lots of great firms out there right now who have both the sort of more balanced view of how this kind of works. Whereas back 10, 15 years ago, it was the kind of Wall Street exploitation piece. That doesn't exist in the same way anymore. That's why, if founders are listening to this thinking, "Oh, I don't want to sell to PE," which a lot of people say to me, I say, "Well, you don't understand what it's like now. And you need to go out there and meet them and go out there and have a conversation with them before you sell your business. And then you make that decision." And a lot of them do that, and they come back and go, "Oh, well, okay, that was," now that they're educated a bit more on it, they can see that pathway more clearly.
Let's ask two questions, one based on the past, your 2 decades of experience, which you've done. You've been very successful and been involved in some big transactions, and in the future. I'd love to hear your perspective on where this is going. So if you have to think back, I'm sure you've got some memories that you hold very fond. What was one of the experiences, memories, conversations that still sticks with you today and, it's probably even shaped the way you do things?
Yeah, I mean, it's funny. People ask me about the private equity stuff, the transactions, which I don't go into because I've had letters turn up saying I shouldn't talk about that. So there are certain things I can say. One of the things that really stuck with me, which I think was a foundational decision, was when I mentioned making all those redundancies, 600 or so in total for this part of the group. I remember at the time, I don't feel proud of this. I remember sort of thinking, "Oh, well, yeah, I'll do that because I'm going to get paid a significant bonus for it." And, who cares, right? Like, it's business. That was my kind of psychology at the time. Now, this is where the table got turned on me. So there was a guy who was running this part of the group at that stage, and he'd promised me this money to do this thing, and the other guys that I was working with were getting this bonus. It's about 100 grand, 150 grand, something like that. So at that stage, it was a meaningful amount of money. And we executed this redundancy program. And I found out that the two other guys that I was working with got paid the money, and I didn't. This is a bit odd. So I ended up having a meeting with this guy, and I said, "What's going on?" He goes, "Oh, well, I just decided not to pay you." I said, "Why?" He goes, "I don't have to give you a reason." And I wasn't that astute back then. We had some agreements, but it wasn't that watertight. And I remember I went to the group CFO and mentioned it, and he didn't like this person who was running the division either. And then they ended up paying me the money, and then I went away and got engaged to my wife around this time. And when I came back, I wasn't allowed in the building. And that was my exit from that part of my world and then I went to Getty Images after that.
Wow.
So what did that teach me, to your question? It started to make me realize at that point about the efficacy of things and being more honorable with stuff. So even when I went into the world of private equity, I made tough decisions, but I also realized that I wanted to be fair. And before that time, I probably wasn't thinking that way.
And the last 2 decades you've been involved in private equity, there's been loads of changes, like the development of social media. I mean, smartphones, when you think of it, they've increased exponentially.
Yep.
20 years ago they weren't. We're now in a digital world. But I think, and I don't have any data to back this up, but the next 20 years are going to be, the growth that we're going to see and the changes we're going to see in professional work, mainly because of AI, is, it depends on how you look at it, scary, exciting, we just don't know what's going to happen. What do you think about the private equity space in particular with the advancements of AI?
Yeah, so if I look at it through just the lens of what PE does brilliantly, which is, as we said, scalable, efficient, well-run companies, AI provides a huge opportunity to go and streamline poor processes and things like that. So we actually, I've been doing quite a bit of this with businesses now, is we'll go in there and we'll do some AI consultancy where we're really just coming in there and looking at where the balance between people and technology is more acute. So I think back to value creation, and in certain industries, particularly, like we do a lot of stuff in professional services and home services, trades-based businesses, there's a huge opportunity to optimize the processes and efficiency through how they go to market, how they get leads, and all of those things through using AI. So that's going to make businesses more valuable. The downside of that, of course, is what does it mean for jobs? And you know what? It's funny, I was talking to my daughters about this the other day, and I still believe that things like creativity and strategy to some extent, even though there are really good AI tools, I think there is a certain human element to things at this stage, which is still really, really powerful. I think if you're going to be going into the world where it's, crunching data, crunching numbers and all that sort of stuff, I think that's a difficult world, right? Because AI can do that quicker, faster, better than anything else. So I think that's the case. The other thing I think could be interesting is that, and I've thought about this a lot, if you're a white collar worker and you're getting replaced by AI, what are you going to do? And I do wonder if it's going to start to move people back more to trades, and it's a very different kind of career thing. But there's been a shift away from some of those kind of artisan positions and careers for years because everyone's been so excited by technology and information. Maybe it'll balance things out again. Who knows? Don't want to bet on that, but I think it's an interesting concept to think about.
Well, I've only said this once before, but I feel like there's another episode here. We've got so much we've covered so much. There's so much left on the table as well. I think by the next time we meet again, sometime later this year, next year, we can see if you were right about the AI, the AI estimations. And then there'll be many more advancements as well. I'm sure your business has grown as well. So today, I'm very grateful for you coming on. I know my audience will appreciate all the private equity perspective, which we haven't had before. And from me, thank you.
No problems at all. It's been great. And I appreciate you having me on.
Thank you very much. And that's the end of the episode. I really hope that you learned as much as I did about the world of private equity with Nick. Please don't forget to like, comment, and subscribe. And I'll see you next Wednesday for the next episode.